The world is driven, this whole space is driven by liquidity and network adoption. So the adoption of blockchain technology is ongoing and relentless, but the liquidity of how much money's around drives the space. Once you understand that, you understand a lot about the space. So last year was a massive withdrawal of liquidity. All the money came out, the central banks were tightening rates, all the banks stopped lending money, all of that stuff. And it meant that all assets went down, and crypto goes down the most because it's the kind of longest duration harsh risk asset. So where are we now? Here we are, right near the end of the rate hikes. The economy is probably going into a recession pretty soon. And so what happens is the markets start to look forward and say, maybe they'll stop tightening liquidity and take the foot off our necks, and maybe things will improve. Because our job in financial markets, particularly macro, is to live in the future. Looking around today is useless, but looking around, what is the world going to look like in 6 months' time? Are the Fed raising rates in 6 months' time? Almost a 0% chance, because inflation has peaked, growth is falling, we're heading into a recession. Normally, they would cut rates at that point. Now they might be a little bit slow to do that because they really want to see inflation lower. But it means that the rate of change of all these rate hikes and all this bad news starts slowing down. If there's one thing macroeconomic investor Raul Paul knows, it's the macro environment. Not only is Raul one of the most knowledgeable experts in the world on macroeconomics, but his predictions for how macro conditions will affect financial and crypto markets have been largely spot on over the last 3 years. In his latest interview, Raul breaks down how he believes the macro environment will play out in 2023 and what it's going to mean for crypto assets and the economy as a whole. Make sure to stick around to the end of the video where Raul lays out when he believes the recession will ease in 2023 and what that means for asset prices. Also, only a small percentage of my viewers are actually subscribed. If you enjoyed finance content, consider subscribing or liking the video. It's free, and you can always change your mind. But we're going to get to the point they're going to say, okay, enough. Meanwhile, China's been leading this. The Chinese economy seems to be a year ahead of everybody else's right now, and they started some stimulus process before their lockdowns. And now they've really started to stimulate because, they shut down their economy. So we're already seeing this global money supply, and people can see me post this on Twitter from time to time. Global money supply year on year and Bitcoin price year on year. They mirror each other, so when liquidity starts to come back in the system, prices start to rise again. So we're at that point, which is why I've been really interested. So in crypto, we've seen that I thought June was the low, and it was in some stuff, other stuff no. But the point being is we've thrown the worst possible news, prices kind of stopped going down, and now we're starting to see liquidity. When everybody else is saying, can't you see, you idiots, you're going to a recession. How could you own SPEGs when you go into a recession? The point being is our job is to look a little bit further into the future. Ghost of your generation is 2008. The ghost of my generation is 2000. All these VCs are a little bit older who are in their kind of 40s. They're like, oh my God, this is 2000 all over again. Tech crash, everything's going down 90. Everybody else is like, well, obviously, what a recession means is that all the banks go bust, everything goes busted. That's not normal. My first recession was 1990. Stock market went down 28, GDP growth contracted by 2%, house prices fell, and people got tipped out of jobs. Standard recession lasted a period of time, the world moved on. That's what I think we've actually got here, is a very ordinary recession driven by Federal Reserve raising rates and prices going up too fast, which means that people can't buy as much stuff because your wages aren't going as much, and so everything slows down. Where's the big imbalance, right? We don't have this. The banking system got sorted out a lot. They're just not allowed to lend as much money, so we don't have those imbalances. So it's very hard to see what's really going to blow up. Now everybody's now the bears who are still going, oh my God, this is the worst thing ever, saying, well, earnings need to come down further, and therefore we've got another leg lower. This is 2000 all over again. We're just not the same level of overvaluation of stuff. Yeah, we were overvalued, but that whole COVID boom has come off. If you look at something like ARK, it's gone back to where it was. Crypto has corrected to the bottom of its logarithmic channel. Everything's got back to where it should be. I think this is a false narrative that the level of interest rates matter. What really matters is the rate of change. So when interest rates go from 0.5% to 4%, you really notice it fast until you adapt, right? So companies get a bit leaner, they're able to afford stuff, all that kind of stuff. But I don't think a 4% level of rates stops companies being built or growth happening or anything else. So I'm not sure that that's really the case. The interest rate issues stop this, and do you think you would not invest in AI because interest rates are 4%? No, that's bananas. Unfortunately, the markets usually recover before that, and particularly the Federal Reserve are saying, look, we want to be tighter for longer. It means that growth coming out of the recession is going to be slower. So I don't think there's going to be a new rush to hiring. We'll probably see unemployment rising. I don't think ad spend comes back quickly because everyone's dealing with, we got too many people, not enough demand going on. So it probably plays out over the course of 2023 and into 2024. While the real recession might have ended by July or September or whatever 2023, we've still got the follow-on effects, and that thing is always where it feels a bit slow and not great. Markets can recover fully, but for us a lot in the real world, it's a pain in the ass. You just held back. If you look through these cycles, they tend to the first year once liquidity turns again, tends to be pretty positive. There'll be some choppiness as well, so it's not a, up-only market. And then the year after that, when the Federal Reserve's dealing with now kind of sticky unemployment growth, that's not great. That's when they kind of tend to do a bit more QE, maybe chucking another couple of rate cuts, and that's usually when the market goes great. It's all over and we go off to the races. So, it's not an instantaneous V-shape. We'll all get back to, full bags again, but it'll feel a lot better over the course of this year, a bit shaky. So every time the market sells off, everyone's going to see it's going back down to the lows. We're all screwed. I don't think so. Let me know in the comments. Anyway, guys, hope you all enjoyed today's video and that provided you with some value. I'll see you all in the next video, and as always, all the best.